Welcome to Investors Edge, powered by SNL. Today, we have the managing partner of Saltwater Funds, Emlyn Scott, with us. Emlyn is a successful founder, VC, and angel investor with personal investments in fast-growing tech companies like Kami, Segna, MealMe, Skylark Labs, and many more. He is also the founder of Open Markets Group, one of Australia's largest online brokers. He was the former CEO of National Stock Exchange of Australia, Australia's second largest listing stock exchange, for 4.5 years. Prior to that, he was the head of business at LCH, ClearNet for equities and CFDs in London for 9 years. That is world's largest independent clearinghouse. Emlyn today is going to talk about his journey so far, startups, and about his latest fund, Saltwater, and how it breaks the traditional barriers of VC funds. Welcome to the show, Emlyn.
Yeah, thanks. Thanks for having me.
Yeah, can you share your journey from being the CEO of National Stock Exchange of Australia to becoming a successful founder and investor?
Yeah, it seems like a lifetime ago now. So I joined the NSX, National Stock Exchange, which is the small stock exchange here in Australia, as the CEO back in 2011 now. So yeah, it was kind of almost a lifetime ago. I just arrived back in Australia from the UK. I'd been over there for 13 years. I'd worked and studied over there. And they brought me in to sort of reinvigorate the market. It was a listed, what still is a listed company, so that taught me a lot about the listing side of the world as well. Running the public company as well as actually listing companies, being a listed stock exchange. And they wanted to, as I said, reinvigorate the market. So I was brought in to bring more listings in primarily, and get the market to start getting more active. To do that, I needed to bring online trading into the market. So because it was phone only broking back then, still needed to sort of move into the 21st century. So I tried to convince the large online brokers to connect to the stock exchange. Unfortunately, couldn't. There wasn't a very strong business case for it. So I got permission from the NSX board to build a new online broker here in Australia. Which I then set off to do, which was a 10-year project into itself. So we built, as far as we know, certainly Australia, but it may have been one of the world's first cloud-based online brokers at the time. So we ring-fenced client data within Australia. So we were actually the poster child for AWS at the time. We signed the first agreement with them to actually do that. Because they were just setting up all that cloud computing, sort of centrally US, etc. But they needed to do it in each country to be able to ring fence client data. And so I was a principal capital raiser for the new broker, and still trying to run the exchange. And I did that for the first 3 or 4 years in parallel. And I kind of figured that if I was messing up the capital raise as badly as I was messing it up, that and given my background in kind of business and finance, I surely couldn't be the only idiot that was. And what I found was it was pretty endemic here in Australia. So that's how it then moved into me setting up another business here, which was CP Ventures, which initially was to help startups raise capital. And the whole process of how you do that and effectively get from the check in the door all the way from the beginning of once you think that you need the capital. I put money also into the broker that I'd set up, and then I also started investing into the startups. What we realized I realized primarily in 2016 was that startups don't really have much money. And so when you're trying to help them, every startup needs the help, but when they can't afford to pay you, it's not the greatest outcome for a business. So we realized that we were seeing some really good companies, and the market here was very nascent for investing. So that's when we decided to set up a fund to start investing into them. And I'd done fund management as well back in the UK. So we set up that here, and there's a special structure here, which is a tax-free vehicle, and that launched in January 2018. And so I'd now left the exchange, decided to work into that full time, while still doing the broker stuff on the side and helping them. And we started to invest into startups, both personally directly and via the fund.
I see.
And so
Any
that was the journey.
Oh, that's very impressive. Any specific reason you chose startups as a mode of investment while there exists so much? And I think real estate is also one that's flourishing in Australia.
I'm I'd done real estate back in the UK, and owned a few places there and done the rentals and stuff like that. And commercial, I actually came from my parents' sort of commercial background, which would have been a natural and probably a much easier evolution here in Australia because everybody loves property here. It's just
Yep.
crazy. Um, I love the startup scene. I used to be a trader as one of my first jobs out of university, and I hated it because it was just paper shuffling to me, and I like building things. So there is no better thing than building. When you're looking at a startup, you're dealing with really enthusiastic people doing cutting edge stuff, trying to solve the world's biggest problems. I mean, what's cooler than that? So when you see it and you get the feel for it, I can't see really anything else that compares with that.
That's very good to hear, and I'm sure our audience will love that. Love that passion coming from a VC. So, can you tell us a bit more about Saltwater Fund? That's something you recently launched. It has a unique approach to venture capital investing. And how do you think it's apart from what already exists out there?
Yeah, there's a few questions there to unpack. So I'd run two VC funds, still do, successfully. Touch wood, as they say, what can go wrong in startup? So we didn't want to do a third fund. As a VC fund. For me, a VC fund is very much like a marketplace. You've got your investors on one side and you've got your startups on the other. And so when we were looking at this, we felt that the model itself, which hasn't really evolved in 50 years, since VC originally was in its first genesis, um, we felt that it really wasn't that fit for purpose, or at least for us. And we I went on a kind of a journey over the last sort of 12 months of trying to articulate what those issues were, because like every new invention, you start with the problem and kind of work from there, and then go, can we solve it? And so I went through a process of trying to articulate what I found as the issues, for me in particular, with VC. And I sat down with lots of people and asked them their views on these things. Yes, there's a problem here, but how acute is it? How big, are you feeling this problem? And the more I looked into it, the more I found that really the only reason people are using it is because there really isn't any alternative. So you can do your own personal investing. That's great, but that takes a lot of time, and you can't get a diversified portfolio particularly easily. In the world of early stage, you need to structure it a certain way to be able to take advantage of the power law. And so when we were looking at this, we were just like, the more we dug into it, the more we didn't want to do a fund three, and so that's where we stood back and went, well, okay, we've got all these problems, but can we fix them? And can we create something better? And that's where we came up with the idea of saltwater. So saltwater, in its essential form. So if you look at the model of VC, 10 years, 2 and 20, and that has a whole lot of structures within it. And obviously you're investing into private companies, and you're doing an LP GP structure. Um, so we went away and went, well, that has a lot of problems or causes a lot of outcomes. And so we went, okay, well, instead of 2 and 20, we'll make it evergreen. Now that changes a whole lot of parts of where a VC model has to invest into things at a certain stage. So you have to raise capital right at the beginning. So you've got certain windows, you have to deploy it, you have to follow on a certain time, then you have to, harvest it in a certain time. And inevitably, VCs start having those discussions, and we're having those discussions now with our portfolio. It's like, well, we've been in you for like 5-6 years now. Like, hey, what are you thinking about exit? And it may or may not be the right time for a company. And inevitably, it usually isn't, because if you want to build something really big, that takes time. And usually it's a time window that a VC can't match. And so you start to have this clash between the company. So that was the evergreen. And then there was the 2% management fees. Now that has a whole lot of problems that I'm sure you're familiar with, from the impact of how much you can actually deploy. So if you're 2% for 10 years, then straight away you can only deploy 80% of your funds. And what does that mean on a multiple basis? And then there's the conflict. So you've raised capital, that's great. So, so what do you do now? You're sitting on this lovely 2% management fee for 10 years just for turning up to work. So, what happens if the LP is in a fund and they're not happy? So they're stuck in that fund, they're paying 2% every year. There's a conflict of interest between the GP and the LP. So inevitably they're going to want to raise more funds, bigger funds more regularly. So all these things start to play out. And that's not a good thing when you're conflicted with your customer. So you get a better outcome when they don't. And then there's the liquidity aspect of the model. That's okay depending on what type of customer you have. But if your customer is a high net worth individual or family office, generally they want to have liquidity. Times change. You can't predict 10 years forward. If you're an institutional investor, generally you don't care too much because staff can come and go and the institution stays. But if you're any of the other type of investing types, then it becomes an issue. And inevitably we get calls from customers or from our LPs, and they go, so you're having any, liquidity anytime soon? My kids are wanting to buy a house, they want to do this, I want to do that. So, or they're retiring or whatever's happening. So life goes on for them. So the model doesn't necessarily fit for them. So that's where we went to a 0-20 model. We're very comfortable that we can make a lot of money for our customers. So we perfectly align with them by going, we won't take any management fee, we'll put 100% into the ground. Then there's other issues like, VCs only do drawdowns. So let's say you want to try and create a portfolio structure. You talk to a VC and you say, I want to allocate 5% of my net worth to VC. Well, that's very difficult. The VC turns around and says, well, I only want 20% deposit, and I want to draw it down with 10 days notice over the next 4 years. And you go, well, great, how do I structure that? So we have 100% up front. So there's these sort of things that we've designed into the model to make it very different. And we've created liquidity into the model. So the way of doing that is to be able to create or invest into both liquid and illiquid securities. So we'll go into the listed market and we'll go into the private market. And both of those portfolios have to be managed quite differently.
How does this evergreen fund model work? It almost seems untrue. 0% management fees, you talk about quarterly liquidity, a lot of benefits for the investors.
Yeah, we've done a lot of modeling, as you can imagine, but Excel's wonderful until you test it in the real world. So to do that, we're starting very slowly and very easily. Chris, the other managing partner, and I are seeding the fund, so that's another issue with with a lot of VC funds that they talk about management, sort of GP commitment, and it's not really. It's like 1% really is that commitment. When your LPs are taking 99% of the risk, and so we're seeding it. We're the largest LPs. We are the largest LPs of our existing funds. So we'll start very slowly. We'll build it up where we're comfortable that we can create liquidity by having that structure between the two asset classes. And they both have to run differently. One has to run on a power law type model, which is your unlisted sort of side of the market, where you get most of your returns from a few investments. And then on the listed side, you run that slightly differently. We're still looking for sort of that fourth industrial revolution technology type companies, but we're now looking for companies that are profitable. We're looking for companies that are far more established, ones that we can see growing and delivering. So, company that everybody would know, something like NVIDIA, you want to try and find the NVIDIA of 15 years ago and then get on that journey with them and find those sort of companies. And so you're looking for a little bit of a different, a much more concentrated structure of companies than you do in an unlisted section of your portfolio.
So is it now concentrated on specific stages like Series B, C, beyond, or you're stage agnostic but trying to find those gems? How does it work?
So on the unlisted side, we still have a natural tendency to like going early because that's where you find the really high IRRs, so really high returns. If you invest in a company at 20 million and you exit at 200 million, for example, you 10x your money without dilution. But if you could have got in at 2 million, well, then you're looking at a completely different return profile. You're sitting on 100x your money. So, but your chance of getting that right is far harder, obviously, because it's far harder to identify. We're very comfortable getting in at pre-seed and seed stage, but we're also very creative. So we're very comfortable doing secondaries and doing, interesting structures with our companies that help them. Um, yeah, it won't just be here. We're just doing pre-seed seed because it comes through the door. We'll actually look at what's out there, and they may be potentially much larger, later stage companies where people want to exit, their holdings or a portion of their holdings, and we see it as a good opportune time to be able to get into those. Plus, I've run a stock exchange, so I'm comfortable listing companies. So, there could be, the potential to be able to invest and then take them down that route of listing their company, etc. And on the listed side, well, the stages we'll be looking at will be much earlier. So I'm not looking at the next $100 billion, $1 trillion Apple company. Anybody can look at those ones. I'm much more comfortable looking much earlier stage. So where the analysts generally don't, or there's very little analyst attention, and scanning those companies and doing deep research, because as a VC, you become comfortable in dealing with the lack of information or lack of external pricing and making your own prices for a company. And so you can apply that to the listed space and, the way your psychology kind of works.
I see. Interesting. So this does change a lot of things for the investors, and in fact takes out a lot of frustration out of the system. We would be interested to know what inspired you to build this model, and also how does this
Hmm.
impact the startups? Like, are you missing out on specific startups because of this? Are you being more risk averse because of this new change? How does this
Mhm.
impact the founders who are listening to this?
Yeah. So maybe if I start with the founders first, I don't think there's any one model that fits everybody. So if you look at most VCs, they will tell you that they will roll up their sleeves and they'll help you. In my experience, you there's some that do and there's some that don't, and so, but everyone says that they will. When we went back over our portfolio, ironically, the companies that tended to do better were the ones that we had the least amount of contact with. Ironically, so either we're really rubbish with our advice, or it's just those founders were just the most talented. They just got on with it. From my perspective, I kind of see it a little bit arrogantly that I can go into a founder that's really, really good, that's working 24/7, and tell him, with, spending an hour a week or 2 hours a week with him, that I know more than he does or that I'm right. That's if I'm doing that, then I've invested in the wrong founder. So I'm better to spend my time looking for founders that want my capital, want my brand. I'll help them when they need to raise capital because obviously we're experts at that stage. But in terms of running their business, just letting them get on with running their business. Report back to us, let us know how it's going. We always love knowing how it's going, and we always want to report to our LPs how it's going, and they get excited with our portfolio. But I don't want to get involved day to day. I don't want to roll up my sleeves. I don't want to be on a board of a company, and that suits some founders and doesn't suit others. In my experience, it generally does suit a lot of founders. The other part of it as well is that if a VC is turning around and saying, "Okay, I've got a certain window that I've got to invest in you and get out of you," that puts a certain pressure on a founder, and a founder's got to then perform in a certain way. If you're an evergreen fund, I don't care if you take 10, 15, 20 years. Just build the biggest, best business you can. So it's a different thing that we're trying to do with the founder. Again, that may suit some and may not suit others.
That's wonderful to know. You also talk about fourth industrial revolution and investing in breakthrough technology companies that are leading this
Mm.
revolution. Can you elaborate on what that means and why is it significant for investors and what does it mean for founders?
Yeah, so for founders, it just means that, if they're doing breakthrough technology, chances are they're hitting one of those. We identified 25 verticals. So there's no true definition of what the fourth industrial revolution kind of technologies are. So we dug into it and we came up with 25 sectors, and then we actually broke those down into subsectors and then subsectors, and then you're in the thousands, of different areas. So what's an industrial revolution? So industrial revolution is just a quantum change in the way that a society kind of operates, but it generally works across three things. So it works across energy, communication, and transportation generally. And we're in the fourth industrial revolution now, and it's very cliche, but it is true. So if you think back to what is it, the 1780s, which was the first one, your energy was your coal and steam. Essentially, your transportation was the steam engine, and your communication was a printing press. And then 100 years later, we moved to fossil fuels and cars and the telephone. Then we had the next evolution 100 years later, about 1960, which was the automation side. So that's when the internet came along. That's when we had renewable energy sort of kick in, and plane travel became sort of mainstream. So there's the sort of three, and now we're in the fourth one. And so the fourth one's super exciting because it's the biggest of all of them, because it's called the intelligent age. So it's actually the marrying of a lot of technologies together, and we're seeing that in our portfolios. So maybe an example of that. So if you look at say, thermal energy, which is an area we've invested. So thermal energy in the past would have been, okay, what have we got that exists today that we can heat up and store energy? But actually now, with the fourth industrial revolution, what happens is that they create material science, which is one of the 25 verticals, and they create a new substance that can store energy that now helps be able to solve one of the other big problems of the world, which is climate change and too much carbon. So, and then the only way to check that material science is through the technologies of being able to use the advanced AI and stuff like that to be able to actually look at all the different potential material sciences that you can put together. So you're getting this connection of a whole lot of different technologies together that make new things that just weren't possible 10 years ago that become possible. And
I
so it's
see.
super exciting now. And
That
so for
is, it's a
investors, that's the best thing, because they can make huge returns faster than they ever could at any other time in history.
Emlyn, something you mentioned last time we talked and stayed with me is that we lead in terms of the revolution. If everyone is already talking about AI, we're already too late. So, how
Yes.
do you identify trends that are going to become trends in the future and already invest in them? And your portfolio definitely reflects that.
Yeah, I mean, the first thing I would say is we get it wrong too. But when we tried to break that down, there's kind of like that. I think it's the Boston matrix, 2 by 2 kind of way of looking at it. And so if you break down what is actually good ideas and bad ideas, and what looks like good ideas and looks like bad ideas, the main two blocks you get are essentially consensus investing or sort of herd investments. So they are good ideas, but they look like good ideas. So that's AI right now, right? So it's mainstream. It's where all the money goes, and where most people get in. They're very comfortable because we're all comfortable being kind of kind of herd to some extent. And then there's contrarian investments, which are good ideas, but they don't look like good ideas because they're too early. So you haven't got much data to work with. And that requires a lot of imagination to be able to look at something and go, what could this look like 2, 3, 5 years from now? If they can actually solve these really, really tough problems and make this thing work. And that's where you make massive returns, but it's not for the faint-hearted. And so when you go in there, you can look like an idiot, because occasionally, you think it's a good idea, and it turns out to not be a good idea, and or it's just too damn hard to do it, or any of 1,000 different other things go wrong. And so that's how we got into generative AI, like, what was it, like 2.5 years ago. Thermal energy, these sort of things. So you can see a big problem there in certain things or opportunities, but the likelihood of pulling it off is very, very small. But if they do,
Um,
the payoff's very, very big.
I'm sure, and it is pretty interesting. I mean, other VCs can actually look at your portfolio and take inspiration, because that is probably going to become the trend in the next 2, 3, 4 years.
I mean, I hope so, because that's where you're solving the biggest problems.
Yep.
Because if you're just jumping on a bad wagon, then you're not really. So
Yep.
that's what we all hope.
Exactly. So you have invested in several tech companies now. Can you share some insights into your investment philosophy and what do you look for in the startups before making an investment?
Sure. So if you break it down probably to the two things, and we've covered one, which is that contrarian. So that's the bit that where you can't easily put your finger on it, but you look at it and you go, well, that's just a crazy idea, but if you pull it off, that's awesome. So that's the bit that I don't think many investors do. And that's the bit that makes the difference. Then you've got the other part that all of us do, which is it a big problem they're trying to solve? It's the breakdown of the list. What's the solution look like? How good's the team? What's their IP and their moat? What's the unit economics? All the stuff that you break down. So that's much more businessy side of the equation, and it's the two things together that make for picking good businesses. And then once you've done that, I think. And I don't hear too many people, do it too much. But if you're doing it deal by deal, then you haven't constructed a portfolio the right way. So everyone's going, oh, what investment this, what investment that, and it's like, okay, that's a nice investment, but how does that fit into what you're actually trying to create? Because it's the portfolio working together that performs produces the return. And how do you do that? And that's really tricky. And I don't know of any asset class that's as hard as doing it as VC. And the reason for that is because you don't know how big your fund's going to be when you start investing. So you don't know the check size. You don't know what's going to come in the door. So you don't know what you're going to have to write. And then you don't know what the follow-on investments are going to look like either. So you're constantly moving these pieces around to try and create something that looks like a portfolio at the end of the day. And that's really, really hard,
I
especially for
see.
earlier stage funds.
So more risk, more reward. How do you battle that startup energy to make sure that you're also generating more rewards for your investors? I mean, with this new fund, you have this hybrid investment approach. And
hmm
does that take away a bit of your risk or make it, even more risky to invest in early stage startups? Want to understand that.
So, it depends on how you define risk, and that's I think there's a big there's a lot of different understandings of it, and I've got a very academic background initially, and it's completely wrong. So you could tear it up and throw it away. It's just years of my life wasted. So generally, risk in the financial world is defined as volatility. So and if you look at volatility, I don't know what's going to happen tomorrow. No one does. Anyone that tells you that they do is, well, they're probably very, very wealthy, but it's just not possible. But the longer you go out in time, ironically, most people see that as increasing risk. But actually, as you go out in time, that that movement of market up and down starts to fade away into a trend, and things start to trend towards their intrinsic value away from sort of that herd emotion of the market movement. And so if you actually look at risk as actually the probability of loss, and I think that's the way the VCs look at it very well. We look at businesses, when every investment we make, we're owning a proportion of a business. So if you look at a business and you look at it from the probability of going, am I going to lose money? I don't care whether the price of something is going up and down. I care about how my business is performing, because I'm not looking at selling it tomorrow. I'm looking at selling it in 10 years from now. And so it's going to trend back to where the intrinsic value, what the value of that business is over time. And so if you're looking at whether it's an early stage or a public company, if you're looking at being able to try and predict and take a view on the business over time, I don't think it actually matters that much between the two. It's more about your perception of the way you view risk. And I think VCs are very good at taking away the market noise, ignoring it, and concentrating on the intrinsic value of the business itself.
Sure. And that's actually most important. Otherwise, you will be stuck in this, making investments, trying to get an exit sort of a route and not be able to actually make that money or that startup fulfill their passion and the dream that they have for the world. On that note, what is your vision for the future of venture capital and how do you think saltwater fits into that vision?
So the future of venture capital, I hope it's very rosy because we need it. That's where the most amazing companies have get their initial backing because they're not going to get it from a bank. What do I see in it? I see more types of different VCs coming about. And that has its pluses and minuses because it means that investors are going to have to try and work out what they want to go into. So choice is good, but some choice is confusing too. And similarly for the companies, because they can get venture debt, they can get standard VC, and then there's all the different terms and nuances of that. So it becomes more complex for founders to have to deal with it. But if the ecosystem and choice, and that's where evolution and hopefully the strongest survive at the end of the day. Hopefully it just gets better and evolves. And I see saltwater just as one piece of that puzzle, that we're adding another another option, and being able to give investors another choice and give startups another potential option of a different type of model. And that will suit some and not suit others, and that's perfect because that's what a marketplace should be.
Exactly. So, talking more about the fund itself from the perspective of founders, you're located in Australia,
hmm
but you have invested globally over the years. So, what about saltwater? Is it also going to be global with a focus on Australia? Only a percentage allocation outside? How does this work? Like, what is the system going to be?
Oh, it's definitely going to be global. So our first fund was in VC fund was 80% or more Australian and 20% offshore because of the certain tax structure of that fund. Our second one was the exact opposite. So offshore. Australia is about 2% of the world's GDP. So if you're restricting your place, your focus onto a really small market, then you're missing 98% of all the opportunities out there. The other thing is that it helps with your eye with picking the deals because while it's harder to look at the whole world and you're kind of like sucking on a fire hydrant of information, if you're going to be a very successful business, you're going to have to do it on the global stage. And so when you're assessing a business, you need to be able to look at that business from a global perspective. And I do think it's much easier to do that if you're constantly looking at companies from around the world. Otherwise, if you're looking at two companies from your local market, you might go, oh, that one's way better than this one. And you go, that's fine. But comparing that business to an overseas business is still not good enough. And that gives you that lens. So we'll continue to invest globally. The vast majority of our funds will be international, of our investments.
Amazing, amazing. And is the fund active now? And if like any founder wants to pitch to Saltwater, what is the best way for them to reach out?
Yeah, we're just Chris and I are just seeding it at the moment, so we're transferring all our assets in. Well, not all our assets, the assets that we're putting in there, and our first investors are coming on board just at the moment. So literally, I came from some of those calls just now, and then we'll be, as I said, doing everything quite slowly because no one's quite done everything that we're doing in one go. So evergreen funds exist, 020s exist, but no one's wrapped everything together into a hybrid fund and done all this sort of stuff that we're doing. So we'll continue to do everything very slowly. We'll probably be making our first new investments because we're also seeding it with an existing portfolio. So we've one portfolio that we're very, very comfortable with. So we'll probably be making new investments first, second quarter next year. And then being evergreen, we'll be doing it forever. So it won't stop. If people want to contact us, they can go to the website. So that's saltwaterfund.com. They can come into my LinkedIn. I think I'm the only person in the world with my strange name. Emlyn Scott. Or they can email. So again, they can find that on the website.
That's pretty cool. My last question: what kind of pitch works for you? What's a compelling pitch in your definition for a startup founder?
Um, that's really tricky because it comes in all shapes and sizes. So I would say first and foremost, concise, um, different, passionate, um, but it's got to be complete. So we're always looking for chinks in the armor, and with startup, there's always chinks. But the founders that can answer the questions and dig below the surface, and have a vision for where their business is going to be, generally get cut through. We're always looking. It's really weird. People go, "How do you pick the businesses?" When you see one, it stands out like a shining beacon. It's so weird. And if you have 100 deals coming into you, one of them will look like that. The problem is 2 or 3 will look okay, and they're really hard to work out whether they can flip up into that shining star, or they're just just a bit brighter than the others.
That's wonderful to know. Any last piece of advice you would like to share with potential VCs or founders out there?
Um, for the founders, extra advice. Oof. Well, they're taking on a rough journey. So I mean, being a founder is, former founder and founder, doing this now. So keep at it. Hopefully the VCs are out there supporting you, not just from writing a check, but more, emotionally. It's a lonely, hard journey, and that's why I think the best investors that have actually been on the journey, because they can empathize instead of sympathize. So.
That's very good to hear. Thanks a lot for your time with us with our audience soon.
Thank you. My pleasure, and happy to chat anytime. Take care.